Imagine if you could grow your money without being a stock market expert. What if there was a way to invest confidently, even if you don't have hours to study charts or the nerves to handle market swings? Today, we're unlocking the secrets of mutual funds, a tool that empowers everyday people to build wealth, step by step. Whether you're a total beginner or looking to sharpen your skills, this masterclass will guide you from the basics to advanced strategies, all in one cinematic journey. Most people dream of making money in the stock market, but reality often falls short. Why? The answer is simple: lack of knowledge, limited time, and emotional decisions. Many investors jump in without understanding the basics, get overwhelmed by information, or panic when markets drop. These mistakes can lead to losses and frustration. But what if there was a smarter, simpler way to invest, one that doesn't require you to be a market expert? Mutual funds are designed to solve these problems. In simple terms, a mutual fund is an investment vehicle where many people pool their money together. This pooled money is then managed by professionals who invest it in stocks, bonds, or other assets. You don't need to pick individual stocks or time the market. Instead, you benefit from expert management and diversification, making investing accessible and less stressful. Let's break down how mutual funds operate. When you invest, your money joins a pool with other investors. This pool is managed by an asset management company, AMC, which appoints a fund manager. The fund manager decides where to invest, whether in stocks, bonds, or a mix. The goal is to maximize returns while managing risks. You, as an investor, own units of the fund, and your returns depend on the performance of the underlying assets. Here's the basic flow. You invest your money, the AMC collects funds from thousands of investors, and the fund manager invests in a diversified portfolio. The value of your investment changes daily based on market performance. You can buy or sell units at the current price, known as the net asset value, NAV. This system makes investing straightforward and transparent, even for beginners. NAV, or net asset value, is a key concept in mutual funds. It represents the price per unit of the fund. NAV is calculated by dividing the total value of the fund's assets minus liabilities by the number of units outstanding. When you invest, you buy units at the current NAV. As the fund's assets grow or shrink, the NAV changes, reflecting your investment's value. Visuals help clarify this. Imagine a pie that grows bigger as investments perform well. Mutual funds come in several types, each catering to different investor needs. Let's explore the main categories. Equity funds invest primarily in stocks, aiming for high growth. Debt funds focus on bonds and fixed income securities, offering stability. Hybrid funds mix both stocks and bonds for balanced risk and return. Index funds track market indices like Nifty or Sensex, and ELSS funds provide tax benefits while investing in equities. Each type has its own risk and reward profile. Equity funds are ideal for investors seeking growth. These funds invest in shares of companies, aiming to generate higher returns over the long term. However, they also carry higher risk due to market volatility. If you're comfortable with ups and downs and want to build wealth, equity funds can be a strong choice. They're best suited for long-term goals like retirement or children's education. Debt funds focus on fixed income instruments like government bonds, corporate bonds, and money market securities. These funds are less volatile than equity funds and offer stable returns. They're suitable for conservative investors or those looking to preserve capital. Debt funds can be a good option for short-term goals or as a way to balance risk in your portfolio. Hybrid funds combine the best of both worlds, stocks and bonds. By mixing equity and debt, these funds aim to deliver balanced returns with moderate risk. Hybrid funds are perfect for investors who want growth but also value stability. They're often recommended for those new to investing or unsure about market movements. Index funds are simple and efficient. They track a market index, such as Nifty or Sensex, by investing in the same stocks as the index. This passive approach means lower fees and consistent performance. Index funds are ideal for investors who want broad market exposure without active management. They're a great way to participate in market growth over time. ELSS, or Equity-Linked Savings Scheme, is a special type of mutual fund that offers tax benefits under Section 80C. ELSS funds invest mainly in equities and have a lock-in period of 3 years. They're popular among salaried individuals looking to save taxes while building wealth. If you want both tax savings and growth, ELSS funds are worth considering. One of the biggest advantages of mutual funds is diversification. Instead of putting all your money in one stock or bond, your investment is spread across many assets. This reduces risk and increases the chances of stable returns. Diversification is the cornerstone of smart investing, helping you weather market ups and downs. Mutual funds are managed by experienced professionals who analyze markets, select assets, and monitor performance. You benefit from their expertise without having to spend time researching or making decisions. Professional management ensures your money is handled strategically, aiming for optimal returns. Mutual funds offer liquidity, meaning you can buy or sell units easily. Unlike some investments that lock your money for years, most mutual funds allow you to access your funds quickly. This flexibility is valuable for emergencies or changing financial needs. You don't need a large sum to start investing in mutual funds. Many funds allow you to begin with as little as 500 or rupee 1,000. This makes mutual funds accessible to everyone, regardless of income level. Small, regular investments can grow into significant wealth over time. While mutual funds offer many benefits, they're not risk-free. Market risk is the most common. Your returns depend on how the underlying assets perform. If markets fall, your investment value can decrease. Understanding this risk is crucial before investing. Mutual funds do not guarantee returns. Unlike fixed deposits, the value of your investment can fluctuate. It's important to set realistic expectations and focus on long-term growth rather than short-term gains. Every mutual fund charges a fee known as the expense ratio. This covers management costs and other expenses. A higher expense ratio can eat into your returns, so it's wise to compare fees before investing. Look for funds with reasonable costs and strong performance. There are two main ways to invest in mutual funds: SIP, Systematic Investment Plan, and Lump Sum. SIP lets you invest a fixed amount regularly, like monthly, while lump sum means investing all at once. SIP is ideal for building wealth gradually and benefiting from market ups and downs. Lump sum works best when you have a large amount and want to invest immediately. Compounding is the magic behind SIP. When you invest regularly, your returns earn more returns, creating a snowball effect. Over time, small investments grow exponentially. Visualize this with a chart. A 5,000 monthly SIP can turn into lakhs over 10-20 years, thanks to compounding. See a real example. If you invest rupee 5,000 every month in an equity mutual fund with an average annual return of 12%, after 10 years, your investment could grow to over 11 lakhs. This demonstrates the power of regular investing and compounding. Even small amounts can create substantial wealth over time. Mutual funds are suitable for a wide range of investors. Beginners who want to start small, salaried individuals looking for disciplined savings, and long-term investors aiming for wealth creation can all benefit. The flexibility and variety of funds make them accessible to almost everyone. If you're new to investing, mutual funds offer a safe entry point. You can start with small amounts, learn as you go, and gradually build confidence. The professional management and diversification help reduce risk, making it easier for beginners to grow their money. Salaried individuals benefit from SIPs, which align with monthly income. Regular investments help build a disciplined savings habit and accumulate wealth for future goals, such as buying a home or funding children's education. Mutual funds make financial planning easier and more effective. Mutual funds are perfect for long-term investors. If you're planning for retirement or major life goals, the power of compounding and professional management can help you achieve financial freedom. Staying invested for years allows your money to grow and multiply. To invest in mutual funds in India, you must complete KYC, Know Your Customer verification. This process involves submitting identity and address proof. KYC ensures your investments are secure and compliant with regulations. It's a simple, one-time step before you begin investing. You can invest in mutual funds through various platforms: AMC websites, banks, online portals, or mobile apps. Choose a platform that's user-friendly, transparent, and offers a wide range of funds. Compare features and fees to find the best fit for your needs. Investing in mutual funds is easy. First, complete KYC. Next, select a fund based on your goals and risk appetite. Register on your chosen platform, set up SIP or lump sum, and start investing. Monitor your portfolio regularly and adjust as needed. The process is designed to be straightforward and accessible. One common mistake is investing without clear goals. Without a purpose, it's easy to lose direction and make poor decisions. Always define your financial objectives, whether it's buying a house, saving for retirement, or funding education. Goal-based investing keeps you focused and motivated. Panic selling during market downturns is another mistake. Emotional reactions can lead to losses and missed opportunities. Stay calm, trust the process, and focus on long-term growth. Markets recover over time, and patience pays off. Following hype or chasing hot funds can be risky. Trends change quickly, and what's popular today may underperform tomorrow. Instead, base your decisions on research, goals, and risk tolerance. Avoid herd mentality and focus on steady, consistent growth. Regularly reviewing your portfolio is essential. Check performance, compare with benchmarks, and ensure your investments align with your goals. Make adjustments if needed, but avoid frequent changes based on short-term market movements. Rebalancing means adjusting your portfolio to maintain your desired asset allocation. If stocks outperform, your portfolio may become riskier. Rebalancing brings it back in line with your goals and risk tolerance. It's a smart way to manage risk and optimize returns. Understanding taxation is important. Mutual fund gains are taxed differently based on the type and holding period. Equity funds have short-term and long-term capital gains tax, while debt funds follow separate rules. Consult a tax advisor to optimize your returns and comply with regulations. Some mutual funds charge an exit load if you redeem units within a certain period. This fee discourages early withdrawals and protects long-term investors. Check the exit load before investing and plan your holding period accordingly. Mutual funds offer growth and dividend options. Growth means your returns are reinvested, compounding over time. Dividend pays out profits periodically. Choose the option that fits your financial goals and cash flow needs. Direct plans let you invest without intermediaries, offering lower fees and higher returns. Regular plans involve distributors and charge higher fees. If you're comfortable choosing funds yourself, direct plans are cost-effective. Otherwise, regular plans provide guidance. Evaluate mutual funds using performance metrics like returns, volatility, and consistency. Compare funds with benchmarks and peers. Look for steady performance, reasonable risk, and strong management. Avoid chasing past winners. Focus on fundamentals. Fund manager plays a crucial role. Their expertise, experience, and strategy impact your returns. Research the manager's track record and investment philosophy before choosing a fund. A skilled manager can make a significant difference. Patience is key to successful investing. Markets fluctuate, but staying invested for the long term allows your money to grow. Avoid reacting to short-term noise and focus on your goals. Wealth creation takes time and discipline. SIP instills discipline by automating investments. You don't have to time the market or worry about volatility. Regular investing builds a habit and ensures you stay on track, regardless of market conditions. Mutual funds are powerful tools for long-term wealth creation. They combine diversification, professional management, and flexibility, making them accessible and effective. With the right approach, you can achieve your financial goals and secure your future. To sum up, mutual funds offer a smart, simple, and effective way to invest. Whether you're a beginner or an experienced investor, they provide opportunities for growth, security, and financial freedom. Start your journey today and let your money work for you. Ready to take the next step? Explore mutual funds, set your goals, and start investing. Remember, the journey to wealth begins with a single decision. Stay informed, stay disciplined, and let mutual funds help you achieve your dreams.